Look at the screen in front of you right now. Silver spot price, $73.34. 1 day ago, that same number read $71.90. The largest silver exchange-traded fund on the planet, iShares Silver Trust, closed the previous trading session at a net asset value of $64.28 per share, a drop of 5.18% in a single day. Every major mainstream financial outlet this Easter Monday is reporting the same three-word explanation for the weakness. Stronger dollar headwinds. That is not an explanation. That is a hallway pass handed out to journalists who do not have the clearance to ask the next question. Because at the exact same moment the paper price of silver is being beaten into submission, a Russian federal law signed in November of 2024, Federal Law number 419-FZ, is quietly executing its second year of a 3-year buying program that allocates 51.5 billion rubles per year, roughly $640 million at current conversion, to the refined acquisition of silver, platinum, palladium, and gold for the Russian state fund. Silver is explicitly named in the explanatory note to the bill. No Western central bank has ever done this in the modern era, and yet not one mainstream financial outlet led with that fact today. I'm going to give you the numbers the mainstream will not put on a teleprompter. I'm going to show you the COT report from Friday. I'm going to show you the LBMA vault figures from London. I am going to show you what Hecla mining guided for 2026 compared to what it actually delivered in 2025. And I'm going to show you the single data point inside the Samsung supply chain that makes every bearish silver analyst on Wall Street look like a man trying to read a map in a dark room with his eyes closed. This is OG John AG. No institutional desk paying me to hold the bag. No compliance officer reviewing my script before it reaches your ears. No asset manager whose quarterly bonus depends on you buying what they are secretly selling. Just filings, vault receipts, and the questions nobody in the mainstream will ask out loud. If you value data over narrative, subscribe to this channel because the people setting the paper price of silver do not want you reading the footnotes. The footnotes are where the trade is. Let me take you directly to London. The London Bullion Market Association publishes monthly vault holdings for every clearing bank and security carrier inside its system. The most recent figure, released for end of February 2026, shows total silver in London vaults at 27,065 metric tons, valued at $78.3 billion. That is a 2.4% decline from the previous month in a single 30-day window. To put that number into proper perspective, London held 34,346 tons of silver at the January 2021 peak. The vault network has now shed over 7,280 tons in 62 months, a 21% reduction from the all-time inventory high recorded when silver was trading below $25. And those are only the reported vaults. That figure does not include the bullion that is quietly moved from the clearing custodians into unreported private vaults in Zurich, Singapore, and Dubai over the same window. Analysts at TD Securities estimated late last year that the true free-floating portion of London silver, metal actually available for lending and delivery, not merely sitting under allocated ownership, had collapsed to roughly 135 million ounces, approximately half of a single day of average global trading volume. Read that again. The free float in the world's largest physical silver clearing center equals 1/2 day of paper trading. Here is the SLV data everyone is misreading. Over the past 3 months, the iShares Silver Trust has seen net outflows of approximately $2.44 billion. Over the past 1 month, outflows of $1.94 billion. Those are the numbers that make the bearish headlines. But look at the 5-day net flow figure. $370.91 million of positive inflow in the most recent 5 trading sessions. Someone is buying the crash. Someone with a balance sheet large enough to absorb a 5.18% single-day drawdown on the 2nd of April and still add shares. BlackRock, the sponsor of the fund, is not disclosing who. Neither is the custodian, JP Morgan Chase, which incidentally holds the LBMA London Vault custody mandate for the physical metal backing those same shares. The same institution that paid $920 million to the Department of Justice in 2020 to settle federal spoofing charges involving its precious metals trading desk. No new charges have been filed, but the pattern, outflow during headlines, inflow behind the headlines, is not coincidence. It is positioning, and it is being done at scale, while retail stackers watch the screen price and panic. The 52-week low on SLV now reads $27.46. The 52-week high reads $107.35. That range represents a 290% volatility band on a single instrument in a single trading year. No serious portfolio manager treats that kind of annual range as noise. That is a structural repricing in progress. The numbers on COMEX are even more damaging to the bearish thesis. As of the most recent warehouse update I can verify, registered silver inventory on COMEX approved depositories sits at approximately 76.4 million ounces. Eligible silver stands at 251.2 million ounces. That eligible figure has fallen by 15.9 million ounces over the past 30 days, a 6% reduction. Registered is down 11.6 million ounces over the same window, a 13.1% cut in 1 month. Now overlay that against open interest. Current COMEX silver open interest represents approximately 571.9 million ounces of paper claims. Divide open interest by registered silver, and you get 7.6 paper claims for every physical ounce that can be delivered against a contract. The delivery pressure ratio against registered supply now reads 464.9%. I'm going to repeat that slowly. For every 1 ounce of silver that is legally available to be delivered against a futures contract on COMEX today, there are paper claims equivalent to 4.64 ounces sitting in the order book. The May 2026 contract enters first notice day in 19 trading sessions. If even a single-digit percentage of those May contract holders stand for physical delivery instead of rolling or cash settling, the exchange will be forced to source metal from a pool that is already 30% smaller than it was 90 days ago. Then there is the Commitment of Traders report. The most recent data, released on the 3rd of April for positions held as of the 31st of March, shows commercial traders, the banks and the dealers who take the other side of speculator positions, holding 90,112 short contracts against 43,723 long contracts. Net short position, 46,389 contracts. Every futures contract is 5,000 ounces of silver. So the commercials are net short approximately 231 million ounces of silver they do not own, against a registered physical pool of 76.4 million ounces. The commercial short position is 3 times larger than the total deliverable physical metal sitting in the vaults. Every $1 move in the price of silver against that position produces a mark-to-market loss of roughly $231 million on the short side of the book. A $10 price move produces a loss exceeding $2 billion before any forced covering begins. A $20 move produces a loss above $4.6 billion, larger than the entire upfront payment BHP received from Wheaton Precious Metals for its Antamina silver stream earlier this year. This is not a stable structure. This is a powder keg with a slow-burning fuse, and someone in lower Manhattan is standing next to it with a lighter. Now move to the mining supply side, because this is where the picture gets worse for the bears. Hecla Mining, the largest primary silver producer in the United States and Canada, reported its full 2025 production on the 26th of January 2026. Full year, 17 million ounces of silver at the top end of prior guidance, with its Lucky Friday mine in Idaho delivering a record 5.3 million ounces. For 2026, Hecla guided consolidated silver production between 15.1 million ounces and 16.5 million ounces. That is a reduction of 11.2% at the midpoint guidance versus actual 2025 delivery. The largest silver producer in the Western Hemisphere outside of Mexico just told the market it will mine less silver next year than it mined this year. But the number inside the Hecla guidance release that no mainstream analyst highlighted is buried on page 3. Hecla's 2026 byproduct credit calculation assumes a silver price of $50 per ounce. That is the price the company used for its own internal modeling against current operating costs. When a producer with 231 million ounces of proved and probable reserves at year-end 2025 assumes $50 silver in its own internal corporate planning documents, that is not a hedge. That is management signaling to its board and its auditors what it actually believes the floor price will be. Pan American Silver came in higher, guiding 25 to 27 million ounces for 2026 versus 22.8 million delivered in 2025. But that increase is almost entirely attributable to the full-year consolidation of Juanicipio, a Mexican mine acquired mid-2025. Organic supply growth across the primary silver producer universe is negative going into the 6th consecutive deficit year. Here is the industrial demand number that has changed everything, and nobody is talking about it. In the first quarter of 2023, silver represented 3.4% of total solar panel production cost. By the end of 2024, it had climbed to 14%. As of current 2026 manufacturing runs from China-based photovoltaic giants, silver now accounts for 29% of the total production cost of a solar panel. The metal has become the single largest cost line item in the entire solar supply chain, exceeding aluminum, glass, and even the polysilicon wafer itself. Trina Solar and Jinko Solar, 2 of the 5 largest photovoltaic manufacturers on Earth, have publicly warned investors in their most recent quarterly filings that they expect net losses for both the 2025 and 2026 fiscal years. Their margins cannot absorb $73 silver. LONGi Green Energy, the largest solar manufacturer in the world by volume, announced that it will begin mass production of copper-based solar cells in the second quarter of 2026 as a substitution measure. But here is the substitution reality the bears will not tell you. Copper-based cell technology takes an average of 3 to 5 years to reach meaningful production scale. Until then, LONGi and every competitor it has are still buying silver at whatever price the market charges them, because a solar panel shipment delayed by copper cell retrofitting is a lost contract. The demand is inelastic in the near term, regardless of price. A solar manufacturer cannot tell its utility-scale customer that the installation is postponed 2 years, while engineers qualify a new metallization chemistry. The contracts do not permit it. Then there is the AI infrastructure demand layer that was not in anyone's model 12 months ago. On the 9th of January 2026, Meta Platforms announced 3 separate long-term nuclear power purchase agreements totaling 6.6 gigawatts of contracted baseload capacity through the year 2035. Counterparties include TerraPower and Oklo, the advanced reactor company that recently entered the Department of Energy pilot program for small modular reactors targeting commercial criticality by the 4th of July 2026. Microsoft, Amazon, and Alphabet have signed combined nuclear power purchase agreements exceeding 10 gigawatts over the 2024 to 2025 window. The International Energy Agency now projects global data center electricity demand will double to above 200 gigawatts by the end of 2030, with the United States alone potentially needing between 100 and 130 gigawatts of new capacity. Every one of those data centers requires silver-intensive power distribution buses, high-conductivity bond wires in the AI chip packaging, and silver-plated contacts throughout the server rack architecture. Goldman Sachs has estimated that meeting the incremental data center power demand between 2023 and 2030 with nuclear alone would require approximately 85 to 90 gigawatts of new nuclear capacity construction, the equivalent of 60 to 90 new large-scale reactors. Each one of those reactors contains industrial silver applications that have no substitute at any price. Reactor instrumentation, control rod alloys in certain designs, and the high-precision electrical systems that govern every coolant pump and safety valve. I have to put the bearish counter-argument directly on the table and engage with it honestly, because anything less is intellectual dishonesty, and your capital cannot afford it. Bank of America continues to publish research pinning silver fair value near $60 per ounce, warning that the metal has overshot its fundamental anchor by roughly 20%. The $1.94 billion of net outflow from SLV over the past 30 days is real and cannot be waved away as noise. European Basel III capital rule implementation could prove less disruptive than the bulls are projecting if the European Banking Authority issues technical guidance, softening the unallocated bullion haircut before the compliance deadline. Copper-based solar cell technology from LONGi could scale faster than historical substitution cycles suggest if Chinese state subsidy flows are redirected into accelerated development. The United States dollar index remains structurally resilient against a basket of major currencies despite persistent inflation, which caps silver's upside in dollar terms. And the Citigroup call that silver would hit $100 per ounce by the end of March 2026 has now definitively missed. March has come and gone. Silver sits at 73. Any honest analyst watching this market has to concede that these are not trivial risks. They are real. The question is not whether they exist. The question is whether they are powerful enough to offset the physical drain, the central bank buying, the photovoltaic cost collapse, and the nuclear data center demand curve that is just beginning to land on the order books of silver miners who are simultaneously guiding production lower. My assessment, based on the numbers in front of me and not on the narrative, is that the bearish factors are tactical and the bullish factors are structural. Tactical wins the week, structural wins the decade. And retail investors who sell into tactical weakness in order to avoid structural repricing are the exit liquidity for the institutions that are quietly accumulating behind the headlines. Now the geopolitics. On Easter Sunday, the 5th of April 2026, the United States military completed the extraction of a downed F-15 airman from a mountain crevice inside Iranian territory after a Central Intelligence Agency deception campaign helped locate the pilot. The improvised airfield constructed by the American military deep inside Iran during the rescue operation is now the single most politically sensitive story on the desk of every foreign ministry in the G20. During the extraction, the American military reportedly destroyed 2 of its own transport planes that had to be left behind on the ground. The Strait of Hormuz remains partially disrupted. Crude oil sits above $100 per barrel. The Federal Reserve's own communications show a 0% probability of a rate cut at the April meeting according to CME Group Fed Funds futures, which means real interest rates are being held above inflation expectations at a moment when the labor market is showing softening and when energy input prices are climbing. This is the precise macro environment in which silver has historically delivered its most violent upside moves, not when rates are being cut, but when they cannot be cut fast enough to keep pace with the monetary pressure building below the surface. The Federal Open Market Committee minutes release on the 8th of April will be the next macro catalyst. The March Core Personal Consumption Expenditures Index release on the 9th will be the second. Both land inside the same trading week in which the May COMEX silver contract approaches first notice day. Citigroup issued a formal research note earlier this year projecting silver at $100 per ounce by the end of March and $110 per ounce by the second half of 2026. The March call missed, but BNP Paribas maintains its year-end target at $100 per ounce for calendar 2026. UBS projects $55 per ounce by mid-2026, which the market has already exceeded by $18. The range of institutional bank targets is extraordinarily wide, from $60 at the conservative end to $170 at the most aggressive private bank modeling. When institutional targets spread across a $100 range on a $73 underlying, that is not a market with consensus. That is a market where the banks themselves cannot agree on where physical reality will reset the paper price. And when the banks cannot agree, the move that follows is almost always larger than any single target forecast. The Citi miss does not invalidate the thesis, it delays it, and delayed repricings in commodity markets with tightening physical supply have a well-documented habit of arriving with greater velocity than the original forecast implied, which brings us to today, the 6th of April, 2026. Spot silver, $73.34. SLV net asset value, $64.28, down 5.18% in a single session. LBMA London Vault Silver, 27,065 tons and draining 2.4% per month. COMEX registered inventory, 76.4 million ounces with a paper claim coverage ratio of 13.2%. Commercial net short position, 231 million ounces against a deliverable pool one-third that size. Russian federal law 419 still running at $640 million per year in strategic silver acquisition through 2027. Hecla Mining guiding silver production down 11.2% for 2026 at a $50 internal assumption price. Trina Solar and Jinko Solar warning of net losses through 2026 with silver at 29% of panel cost. Meta Platforms locking in 6.6 gigawatts of nuclear power for AI data centers that will consume silver in every chip package and every power bus. And a United States F-15 pilot just rescued from a mountain crevice in Iran 24 hours before the opening bell rings in New York. Every single one of these data points is verifiable. Every single one of them has been published by a primary source, CME Group, the LBMA, the CFTC, the Russian Ministry of Finance, Hecla Mining Investor Relations, and the quarterly filings of publicly traded solar manufacturers. None of them require a conspiracy to be true. They simply require that you read the filings instead of reading the headlines. And if you read the filings, the only remaining question is not whether silver repriced. The question is when the repricing arrives with enough velocity to force the commercial short position to cover into a market with no available physical supply. The algorithm cannot tell you when. The LBMA cannot tell you when. I cannot tell you when. But the vaults are draining, the producers are cutting guidance, the central banks are buying, and the paper price is $73.34. If you are watching this video right now and you read this far, you are in the top 1% of silver investors on this platform. You did not skim, you counted the ounces. You weighed the data against the narrative, and you noticed that the narrative and the data are pointing in opposite directions. That is the entire edge. That is the only edge that has ever mattered in precious metals investing. The people with access to the delivery trucks and the vault receipts do not need the screen price to tell them what silver is worth. They already know. Your job is to catch up to their information before the paper market catches up to the physical market. Hit the like button if this content was valuable to you. Share it with one person who is still trusting the 6-month price chart instead of the delivery reports. Subscribe to this channel if you have not already, because the next update will arrive the moment new vault data, new COT data, or new central bank filings cross my desk. And drop OG John AG 2.0 in the comments section below, not because the algorithm cares, but because every time a new viewer sees that phrase repeated, they understand instantly that this community is built on verified sources and not on noise. The screen price is a lagging indicator. The delivery notice is the leading one. Watch both. Trust the second one. Invest with logic, never with noise. OG out.